Trading strategies video, we're going to talk about the bearish strategy of buying put options. So let's go ahead and get right into the strategy characteristics of buying put options. So buying a put option is also known as a long put position, and this is a bearish strategy that benefits from a decrease in the stock price or an increase in implied volatility. Now, compared to shorting shares of stock, a long put has similar profit potential but significantly less loss potential. And that's because when you short shares of stock, you have unlimited loss to the upside, but when you buy any option, the worst case scenario is that that option expires worthless, and in which case you have limited loss potential. So the maximum profit potential of a long put strategy is the put's strike price minus the premium you pay times 100. Now the maximum loss potential, as we just talked about, is the premium paid times 100. So you have limited loss potential. Now the break-even price at expiration is the put's strike price minus the premium you pay. So to make any money or to just break even on the strategy, you need the stock price to reach the put strike price minus the amount that you paid for the put. Now, because of this, the estimated probability of profit for a long put strategy is less than 50%. And that's because you're going to need the stock price to decrease by a certain amount just to break even, and that's going to give you a lower probability of profit. Now, the resulting position after expiration depends on if the long put is in the money or out of the money. If the long put is in the money at expiration and you hold it through expiration, the resulting position will be negative 100 shares per contract. So that's a short stock position of 100 shares per contract, and you'll be selling those shares at the put's strike price. Now, in regards to assignment risk, the long put strategy has no assignment risk since you own the option and there are no short option components to the strategy. Now that you know the basic characteristics of the long put strategy, let's go ahead and look at a basic example and check out the expiration risk profile graph. So here we have a bunch of different strike prices and the corresponding put prices. So at the time of these prices, let's say the stock price is trading for $150 and we want to initiate a bearish position. So we're going to buy the 150 put for a $5 premium. So the stock price is at 150. We're going to buy the put with the strike price of $150 and we're going to pay a $5 premium for that put. So let's go ahead and see what the expiration risk profile graph looks like for this position. So as we can see here, all of our profit potential is way on the left side, which means the stock price is decreasing, and that profit potential increases steadily as the stock price is decreasing. Now on the right side, we see that we have limited loss potential equal to the amount we paid for the option times 100. So since we paid a $5 premium for this option, the most we can lose is the $5 premium times 100, since that's the standard option contract multiplier, which gives us a maximum loss of $500. So the maximum loss occurs when the stock price is at or above the put strike price at expiration, because at those prices the put will expire worthless. So if the stock price is at $150 or above $150, we will lose $500 at expiration because that put's going to expire worthless. Now our break-even price is the put strike price of $150 minus the $5 premium we paid for it, which brings us to $145. So as we can see here, if the stock price is at $145 at expiration, we're going to break even, and that's because at expiration an option only carries intrinsic value. Now at $145, a put with a strike price of $150 will have $5 of intrinsic value. And since we paid $5 for that option, we have no profits and no losses on that position. Now let's say the stock price falls to $130. At expiration, the put with a strike price of $150 will be worth $20. And since we paid $5 for it, we'll have a $15 profit on that option. Now that $15 profit actually corresponds to a real dollar amount of $1,500. So this expiration graph just shows you the potential profits and losses for this long put position at expiration. So now let's go ahead and take a look at the option Greek exposures of the long put position to help you understand how the long put position can profit before expiration. So let's take a look at the long puts Greek exposures to help explain the strategy. So as we just discussed, a long put is a bearish strategy, and that means its delta is negative. So put prices fall when the stock price rises, which is detrimental to put buyers, and when the stock price falls, put prices increase, which is great for put buyers. So the position delta of a long put position is negative. We want the stock price to decrease. Now the gamma of a long put position is positive. Now that means when the stock price decreases, we're going to subtract gamma from the option's delta. Now since the delta is already negative, if we're subtracting a positive number from a negative number, we're going to get a even more negative number. So all that the combination of the negative delta and positive gamma tells us is that as the stock price decreases, the long puts position delta will grow more towards negative 100, so more towards a short stock position of 100 shares. And as the stock price increases, the position delta will approach 0. So what this means is that you want the stock price to decrease in a very, very quick manner, and you want it to continue to decrease because let's say you start out with a position delta of negative 50. If the stock price decreases by $1, you're expected to profit by $50. However, if the stock price decreases enough and your position delta grows towards negative 100, if the stock price decreases another dollar, you're expected to profit by $100. So, as you can see, the further and further the stock price decreases, the more and more your subsequent profits will be for continuations of that downside move. Now, the theta of a long put position is negative, and that's because the extrinsic value of options decays away as time passes, which leads to decreasing option prices. Now, when you own an option, you do not want the option price to decrease, so negative theta tells you that you're expected to lose money over time when you just own the put option, and you're going to lose money if the stock price does not move because the extrinsic value of that put is going to be withering away. Lastly, a long put position has positive vega. Now, an increase in implied volatility indicates an increase in option prices, which is great for put buyers. Now, a decrease in IV indicates falling option prices, which is harmful to put buyers. So, when you own any option, you are long vega, which means you want option prices to increase because that will benefit your position. So, when we put all of these things together, we learn that a long put position profits when the stock price falls or implied volatility rises enough to offset that negative theta. So time is your real enemy here, and you need a decrease in the stock price or an increase in implied volatility to occur fast enough and with enough magnitude to offset that negative theta. Alright, so now that you know the theory behind the long put position, let's go ahead and take a look at some real trade examples to show you how a long put might perform as the stock price is changing through time. So the first example we're going to look at is where a trader buys an at-the-money put. So an at-the-money put is where the strike price is right by the current stock price upon entering the trade. So here's the setup. The initial stock price is $77.21. Initial implied volatility is 37%. The put strike we're going to look at buying is the 77.5 put expiring in 74 days. Now we're going to pay a $4.95 premium for this put, which brings our break-even price to 77.5, which is the put strike price, less the $4.95 premium we paid, which brings us to a break-even price of $72.55. Now the maximum profit potential is $72.55 times 100, which is $7,255. Now this comes from the fact that if the stock price goes to 0, that 77.5 put will be worth $77.50. And since we paid $4.95 for it, our net profit will be $72.55. Now $72.55 times 100 is $7,255. So that maximum profit potential is only realized if the stock price goes to 0, which is extremely unlikely. Now the maximum loss potential is the amount we paid for the option, which is $4.95, times 100, which is $495. So let's go ahead and take a look at how this position performed over time. So in this chart, on the top we're looking at the changes in the stock price, we're looking at the put strike price, which is the dark dashed line, and we're looking at the puts break-even price. And we're also seeing any intrinsic value that that put has, because the intrinsic value indicates how much the option will be worth at expiration. So more green on that chart is good for put buyers. So as we can see here, the stock price starts around $77.50 and it falls a little bit, but then kind of just meanders around that strike price. Now, between 74 days to expiration and 30 days to expiration, we can see that this long put position actually has losses because the long put itself is decaying in value. Now that is described by negative theta. As we talked about, if time passes and the stock price is not moving and implied volatility is not changing, the option will lose value because its extrinsic value is decaying away. So the loss on this long put position between 74 days and 30 days to expiration can be attributed to theta decay. Now, between 30 days to expiration and 0 days to expiration, we can see that the stock price actually rallies to a price above the long put strike price, in which case there is no more intrinsic value for the put. So, in other words, if the stock price remains above the strike price, the put will expire worthless at expiration. Now, as we can see, the stock price in this example is above $82.50 at expiration, which means the 77.5 put is completely out of the money. And as we can see on the bottom part of the graph, the put price at expiration is $0. So if we were to buy this put option and hold it to expiration, we would have lost $495 per put contract. Alright, so example number 2, we're going to buy an out of the money put this time, which is a little bit of a lower probability trade because when you buy an out of the money put, if the stock price doesn't decrease significantly, that put's going to expire out of the money. So an out of the money put purchase is a very aggressive trade because you need a big stock price move to profit. So let's go ahead and see what happens here. So here's the setup. The initial stock price is 103.40. Initial implied volatility is 26%. The put strike price in expiration is the 98 put expiring in 39 days. And the premium we're going to pay for this put is $1.49, which brings our break-even price to the put strike price of $98 less the premium paid of $149, which comes out to $96.51. So our maximum profit potential is $96.51 times 100, or $9,651 if the stock price goes to 0 in the next 39 days. Now the maximum loss potential is the amount we paid for the option times 100, which in this case is $149. So let's go ahead and see what happens to this put position over time. Alright, so again, in the top part of the graph, we're looking at the changes in the stock price, the put break-even price, the put strike price, and any intrinsic value the put might have. In the bottom part of the graph, we're looking at the initial purchase price of the put, and we're looking at the actual put price through time and any corresponding profits or losses for the put buyer. So in this case, we can see that the stock price starts around 103.40 and actually in the first couple days there drops to around $98. So that's our put strike price. Now while the put didn't have any intrinsic value at that point, we can see that the put's price actually increased from $1.49 to right around $3 as the stock price was decreasing towards the put strike price. So this just shows you that you actually don't have to wait until expiration to realize any profits, as you can always just sell the put in the open market, before it expires. So let's say you bought this put for $1.49 with 39 days to go, and with 31 days to go, you wanted to sell the option for $3. Well, you could sell the option for $3 and you would lock in a profit of $151 per contract. So that would be the $3 you sold it for minus the $149 you paid for it times 100, which gives you $151. Now, let's say you didn't sell it and you just kept holding on to it. So as we can see, the stock price didn't actually get below the put strike price until about 12 or 13 days to expiration, and that was short-lived and the option actually expired out of the money at expiration. So this example just shows that if you bought this put for $1.49, since the stock price was above the put strike price and break-even price at expiration, this put actually expired worthless and you would have lost the entire premium you paid for it. So let's go ahead and look at another example. Alright, in the final example, we're going to look at buying an in-the-money put. Now here is the setup. So the initial stock price is $254.51, Initial implied volatility is 37%, and we're going to look at buying the 300 put that expires in 63 days. So this is an in-the-money put because the strike price that we're buying is significantly above the stock price. So the put purchase price is $52.70, so we're paying quite a lot for this option, but that's because it is in the money and most of its value is intrinsic. So this brings our break-even price to the put strike price of 300 less the premium paid of 52.70, which comes out to 247.30. Now the maximum profit potential on this trade is 247.30 times 100, which is $24,730, which only happens if the stock price goes to zero in the next 63 days. Now the maximum loss potential is the amount we paid for it times 100, which comes out to $5,270 in this case. So like I said, we're paying for a lot of intrinsic value here, which means we're paying a high premium for the put. So our loss potential is pretty high here, but at the same time, if the stock price remains at its current level, that put's going to be worth around $45 because that's the amount of intrinsic value it has. So if the stock price doesn't move, we're not going to lose the entire $5,200 because this option does have intrinsic value at the time of putting it on. Now let's go ahead and see if that changes. Alright, so in the top part of the graph, we're looking at the changes in the stock price relative to the put's break even, the strike price, and the amount of intrinsic value it has. So as I said before, this put is in the money, which means it starts with intrinsic value, and that explains the expensive premium we paid for it right off the bat. Now on the bottom part of the graph, we're looking at the changes in the put's price through time as the stock price is changing. So what I want you to pay attention to is between 63 and 49 days to expiration, the stock price didn't really decrease that much. It was actually very flat. And over that same period, the put price did not decrease that much. Now that can be explained by the fact that most of this put's value is intrinsic, which does not decay away as time passes. So one of the benefits of buying an in-the-money put is that you're paying mostly for real value or intrinsic value, which does not decay away as time passes. Now as we can see, the stock price actually decreased from around $250 to around $200, in which case the 300 put rose in value from around $52 to nearly $100. So this put actually doubled in value because the stock price fell more than $50 from the entry price. So at expiration, this stock price was below the break-even price of $247.30, and overall the position was profitable. Alright, so that pretty much wraps up what you need to know about buying put options. So let's go ahead and recap the main concepts discussed in this video. So buying puts is a strategy used by traders who have a strong bearish outlook for a stock, as the trader must correctly time the fall in the stock's price, otherwise you're going to lose money from theta decay. Now, buying a put has limited loss potential and significant profit potential, but also a lower probability of profit as a result of that relationship. A long put position benefits from decreases in the stock price or increases in implied volatility, but loses money from the decay of extrinsic value as time passes. So as we discussed before, the stock price must fall or implied volatility must increase enough to offset the losses from time decay. So you have time working against you and you need a directional movement or a volatility movement in your favor to offset those losses from time decay. Now to close a long put position before expiration, you can simply sell the put at its current price to lock in profits or losses. So we did go over that in one of the examples before. And lastly, if a trader holds an in-the-money long put through expiration, the resulting position will be negative 100 shares of stock per put contract. So if you hold an in-the-money put through expiration, you're going to short 100 shares of stock at the strike price of the put that you purchased.